Hi, everybody. Good morning, afternoon. Um, Welcome to the session on continued trade disruption and the challenge of supply chain diversification. So I think all of us who are involved in the trade process, we know about the many challenges that we faced, many of them pre-COVID. And now a lot of these challenges, they remain as relevant as ever, and I would say in many cases, more acute, whether they be geopolitical issues, concentrations that corporates have had with their supply or sourcing activities, the efforts associated with digitization, sustainability, and more broadly ESG, whether it be access to finance for buyers or companies' supply chains, and more recently meeting big spikes in demand and the not too distant past dealing with supply shocks as well. So we're going to try to cover as much of that as we can. We have a terrific panel that comes from a variety of different perspectives. We have folks who can speak to government or multilateral government perspectives and policy response. Folks from technology, from maritime, and your humble moderator coming from the banking and trade finance perspective. So just some quick intros all around. I'm John Richman. I will be your moderator. I run the trade finance business for Santander in the US. I've been in the trade finance business for quite some time. I've been with Santander for just a few years, but before that, quite some time with Deutsche Bank and the Standard Chartered Bank for many years and in several different regions around the world. So I am going to let my panel introduce themselves. We'll start with Rosemary.
Hi, good morning, everyone from Silicon Valley. I'm Rosemary Coates, and I am the Executive Director of the Reshoring Institute, where we help companies evaluate their global supply chain strategies and hopefully help them find an opportunity to bring some manufacturing back to America.
Thank you, Rosemary. Rob from IBM.
Hey, good morning, good afternoon, good evening, everyone. I'm Rob Cushman. I lead IBM's supply chain transformation business globally. And what that means for us is helping our clients reinvent their operations and supply chains in the world of cloud and analytics and machine learning and AI. We'll talk about some of that today. I've been doing this for almost 30 years. Some of that as a consultant and some of that as a line industry executive. And so delighted to be here and look forward to the discussion.
Thank you, Rob. Andrew from ICC.
Thank you, John, and good morning to everyone from rural France. Not quite as cool as Silicon Valley, I have to say, but that's life. I head up the global policy team at the International Chamber of Commerce. Many of you will know us from the work we do in the trade finance field, setting rules and standards for a variety of different instruments. But more broadly, we're a global business organization with 45 million members, founded just over 100 years ago with a mission to promote trade as a force for good in the world. Many thanks.
Thanks, Andrew. And Ron from Windward.
Thanks, John. Morning, everyone. It's great to be here. So I'm Global VP of our of commercial. So I'm based in London, and I lead the energy and the supply chain business lines. So I'm a chartered shipbroker by trade. My career has always been rooted in ships and ports and energy for the last 27 years. And I've watched what Windward have been doing with AI and data science for years now, and I got an opportunity to join the team pretty much exactly 2 years ago to really double down on the technology side of maritime, along with the sea, which is also a real passion of mine. So looking forward to the discussion.
Great. So thank you for that. And I think a lot of different perspectives we're going to get here today. So we're going to have a discussion, which I will moderate, but I would encourage the audience to ask some questions. We'll keep, say, the last 10 minutes or so of the session free for questions from the audience. So for today's session, we're going to break it up into three broad categories. It's such a big topic. So first, I'd like to discuss with everybody the impact of COVID and how things are unfolding as we now enter what seems to be the recovery phase. Then I'd like to dive in more specifically about the trends with digitization, since that's such a hot topic, trends and challenges. And then finally, I'd like to wrap up with a discussion about the other risks and issues in the supply chain, namely diversification, but security and other topics that we'd like to talk about, and how companies are managing these. So let's begin. Let's first talk about the impact of COVID on supply chain management. And we'll start with Rob from IBM. Rob, the past year has been, I would say, the most important year that I know of in supply chain management. This topic now has a seat at the big table in the corporate boardrooms, certainly like nothing we've seen before. What would you say the critical lessons that we've learned about supply chain management have been during the pandemic?
Thanks, John. And, oh, what a year. I think, in my, as I said, almost 30 years of working in this space, we've never seen anything like this. And I like to think of it as, what I tell my teams is, there's never been a more exciting time, right, in this profession. I think we've also just witnessed sort of the defining moment, right, for the kind of coming of age or relevance of supply chain, right, kind of in everyday life, for human beings, right? And the pandemic has really laid bare, right, the kind of the cracks and fissures, right, in the supply chains of the world, right? And for those of us who kind of live and work there, right, I think we've always known that there were risk points, but I think we probably all were surprised by how the convergence of so many things, right, were so incredibly disruptive to the world that we live in. And it's really laid clear this, very large gap between kind of the best and the rest. And I think what do we learn? I think we learned that the assumptions behind these, kind of traditional integrated supply chain models that we built in the 90s and early 2000s, right, are much more fragile than anybody thought, right? They're built on an assumption of, pretty consistent demand and supply patterns, some spikes and troughs, right? But generally pretty consistent, regular physical flows, predictable from, where we make things to where people consume them, right? Kind of how we move them, right? Physically. And so I think, what we now know, right, is that, kind of all of that can get upset very quickly, right? And we were able to have humans intervene, right, and brute force things, right, through kind of sheer force of will. But we, that was, I think, much more inefficient and expensive and hard on people than we thought, right? And so kind of now, kind of on the flip side, right, we see these, digitally enabled companies who've embraced, kind of technology, right, have the ability to be, kind of much more forward-looking, using, predictive technologies to kind of look around the corner, right? And they've performed much better, right, and been much more flexible and agile. So where does that leave us today? I think, ordinary people really understand, right, the essentialness of supply chain in ways that they never have before. I see it as kind of business customers now, right, are very intolerant of why their B2B supply chain experience is inferior to what they get with Amazon or Walmart or Uber, right, in their personal life, right? So there's this kind of big gap now that's emerged. As you said, John, right? So supply chain is really now it's a board level topic. It's a board level priority. It's a board level, investment focus, right? And so the way we see it is really the race is on now, right, to kind of close some of those big gaps and prepare for the next global disruption, right? Because we know what's coming.
Let's hope the next big one may take a little bit longer. We got a break, but yes, resilience definitely seems to be a key theme. I'd like to switch gears a little bit. Rosemary from the Reshoring Institute. I mean, there's no question that there's a new focus from a government perspective on U.S. manufacturing, and President Biden has announced a number of policies that seem to support U.S. manufacturing. So, what would you expect in terms of financial help for U.S. companies or manufacturers? You're on mute, Rosemary. That's the quote of the year.
Yeah, that's right. I've seen T-shirts that say you're on mute. I think to understand why the response now, you need to understand a little bit of context in the history. From a reshoring perspective, I've been in global supply chain management for 35 years and spent about 15 years helping companies offshore to China and to set up operations in China. And then in 2012, during the presidential election in the US, both Mitt Romney and Barack Obama were China bashing like crazy. And I'm like, oh man, I can't tell anybody what I do for a living. This is awful. And so we did a pivot and started talking to our clients about the potential for manufacturing in the US. And so reshoring, we established the Reshoring Institute about 7 years ago. And, we sort of bumbled along for a while. I mean, we were sort of busy and, making little waves. And then in 2017, the U.S. Congress passed the Tax Reform Act, and it reduced the taxable rate for manufacturers from the close to 30% down to 21%. And the idea was that would force manufacturing to come back. But almost nothing happened. The companies took advantage of the tax break, but they didn't use it to reestablish manufacturing. And then we had the trade war, which is ongoing still today. There hasn't been any reduction made in the taxes. So the 301 tariffs that were applied to any incoming goods from China are still in place today. And the idea there was because those imports were more expensive, that it would result in U.S. manufacturers reestablishing manufacturing in the U.S. But nothing happened. It was just, our clients were essentially just absorbing the additional costs into their cost structures or passing on the additions to their customers. But the pandemic, when the pandemic hit, as Rob mentioned, all of a sudden, the people stood up and took notice, and supply chain became an actual term that people talked about. And having been in the industry for 35 years, I got to tell you, I kind of enjoyed it, because now people know what I do for a living. But when the pandemic hit, it introduced risk for the first time. So it's not just the financial, and although companies are economic entities, this time risk combined with the potential for a revisiting of those economics really made people sit up and take notice. And all of a sudden, there's a lot of emphasis being placed on reshoring now and reevaluating global supply chains. And I think this is recognized. Your question was about the Biden administration and what they're doing. So they have, Biden has issued several executive orders for focus on supply chains and Buy American. So, most countries around the world have some kind of Buy Domestic Act in place, but they aren't well enforced, including in the US. We've had a Buy American Act on the books for probably 60 years. But not well enforced, and no emphasis was placed there. So one of the executive orders was Buy America. Another was, placed on emphasis for manufacturing in America and so forth. And then just last week, the Biden administration released the 100-day study which is a global supply chain study identifying risk in 4 areas: batteries, semiconductors, rare earth elements, and one other. Can't remember, but and overall on supply chains, but those 4 areas in particular, oh, pharmaceuticals and medical. So those 4 areas are getting the most attention, although supply chain across the board was also addressed in this report. And I think what we can expect and what's mentioned in the report is there's likely to be financial help coming. So there's help on the way, either through the Infrastructure Act or through other grants and emphasis and availability of funds and low-cost loans to manufacturers who want to take advantage of those loans to either expand manufacturing in the U.S. Or bring it back from overseas, or to decide never to go overseas. So I think we're going to see a boom in investment in manufacturing in America, and with help from the government.
Wow. Okay, that is interesting for sure. Ron, Ron from Windward. We have a lot of people with starting with Ron, Rob. Gets a little confusing. So, yeah, COVID created a lot of disruption in the supply chain, and it revealed a lot of structural weaknesses in the global trade process. I know you see it from a maritime perspective. How did you see it play out over the last year, and where do we go from here?
Yeah, it's an interesting one, because I think, so I'm looking at it from a tech company in the maritime ecosystem through that frame. So I guess like any complex system, it's got vulnerabilities, as Rob said, you know, fissures and cracks in the system. And I think what we've been looking at over the last while is which ones make the biggest difference. So I guess from my conversations, particularly around when I look on the supply chain side of our business in, you know, with freight forwarders and shippers, it seems like the most pressing issues around what we describe as real-time transportation visibility. And I think what's been surprising to me, having been doing this for a long time, is there's surprisingly little visibility in terms of ETA, for example. Simple thing, or what seemingly simple things, but actually are devilishly difficult to solve. So I think things like, you know, changes in schedules, or you know, particularly around the ocean segment of supply chains, is very hard for people to track. And just as an example, I think from our research, something like 40 to 50% of containers are late, which again, I was pretty surprised about, even though I'm in the industry for a long time. So I think the ability to dynamically forecast and have some sort of advanced daily warning of ETA changes before they happen even is going to become a critical success factor, particularly for those groups that I spoke to, you know, the freight forwarders and the shippers. But it doesn't help with volatility. I mean, we've seen, you know, the second order consequences of COVID-19 having a fairly dramatic impact, because empty containers ended up in the wrong place because, you know, manufacturing slowed down during the pandemic, and as a result, demand slowed. So suddenly there's a vessel shortage, and then that plays havoc with freight rates. So that, you know, the havoc with freight rates needs to be swallowed by someone. So it's either going to be the shippers themselves, or they're going to pass it on to their customers. And I think we're in, what is it, 16th of June now. So we're just coming to a crunch point, I think, because in July and August, they're typically the busiest months for China westbound to the USA and eastbound to Europe for the holiday inventory stock. So I think that'll be an interesting point in the next couple of months to see how this plays out, because we're heading for something that, I hate to use the word unprecedented, but we're certainly heading for another version of that. So in terms of where we go from here, I'd suggest that any plans that companies are putting together right now would have to include building more resilience and capability around forecasting ETA prediction. And I think that kind of visibility will be a game changer for the groups that we talked about.
Certainly, resilience is a key theme I keep hearing, and I'm hearing from this group, and I hear it a lot in my own circles. Let's pivot to Andrew from the ICC. So Andrew, the ICC, as I personally know, has a trade register, which I fondly look up from time to time. It tracks the performance of trade assets. Maybe a sneak preview for us. Are there any interim findings that you can share with us about the pandemic's impact on the trade finance gap that everybody always likes to refer to, the the gap in terms of finance availability, especially for the smaller companies?
Well, thank you, John. I think someone's clearly given you inside intel, because we're about to launch the interim findings of the 2020 and 2019 data actually just tomorrow. So I've got to be careful not to completely drive a coach and horses through the embargo I myself set. However, I think the good news in terms of what we've seen is that trade assets seem to have performed relatively robustly through the crisis. So we've seen a spike in defaults in 2020, but it isn't anything outside the bounds of what we've seen in previous years. The bad news that I think, particularly when you view this through the lens of the so-called trade finance gap, which I think before the crisis was estimated in the region of 1.4 trillion US dollars, is, first of all, we've seen something quite interesting in the 2019 data, which is a spike in SME defaults in a number of asset classes, which would appear to signal, certainly in a couple of regions, that perhaps the economy was headed for some kind of downward cycle prior to the pandemic hitting. Now, that's simply an initial hypothesis, but it does suggest that perhaps the economy wasn't in the best of shape, and 2020 may have ultimately been a recession year, regardless of what happened with the COVID-19 virus. The second piece of bad news or worrying news is that clearly what we're seeing in terms of the initial data analysis is heavy cushioning from government support schemes or stimulus schemes. So in countries and regions where stimulus has been extremely strong, we've seen a pretty low or flat rate of defaults. Where it's been weaker, coupled with stringent lockdown measures from governments, we've seen a much more pronounced rate of defaults. Mexico is a good example that stands out for a number of assets. And the big concern we have looking forward, putting that data from 2019 together with the cushioning impact, is what happens when stimulus is withdrawn. So will we potentially see credit conditions tightening quite significantly as banks become concerned about their exposure to certain parts of the economy, particularly small businesses? And what will that mean for the trade finance gap? So I think we're not out of the woods yet in terms of access to credit. And I think the key message from our side is we need governments to be vigilant on the ability of small businesses to access bank finance for working capital and trade, and to intervene as appropriate, which we think ultimately means an extension of credit guarantees long into this year, probably into next year as well.
Okay, well, I'm certainly looking forward to the full report, like I do every year. I'll just give my perspective as the trade finance banker here. My experience during COVID and as we come out, I think that trade finance proved to be, as it always does during every crisis, the most resilient form of finance. When commercial paper markets locked up, trade finance remained available. Our experience has been also from a risk point of view, performance has been better than probably many expected, and hopefully the report bears that out. I would also say that there are some learnings for a lot of companies. One is diversification. So obviously we're talking here about diversification of supply sources, but diversification of liquidity sources is equally important, and not to be overly reliant on whether it's commercial paper or trade finance or any other source. One needs to diversify and have many tools in the liquidity management toolkit. And I certainly think the focus on supply chain finance has increased as a result of COVID. The idea of having a win-win solution with your suppliers or your customers is now more important than ever. It supports the supply chain in times of stress. And I think what I see going forward is more ESG linkages with these programs, companies trying to do good and make sure their supply chains are sustainable, and support their trading partners is quite key. So I think that there's definitely a storyline that links all that together. Now I'd like to switch gears and talk about digitization, which I hear all the time in my industry, and I'm sure you're hearing it in yours as well. the digitization in the supply chain, big trends, big challenges. And here, Andrew, we'll begin with you. The ICC has advocated extensively with the G20, with central banks, with financial institutions like ours, about the role of digitization in ensuring the continuity of cross-border trade. So what reforms would you say would be most useful in the near term to further reduce disruption in supply chain?
Thanks, John. As you rightly said, we came out quite heavily at the start of the crisis, seeing the potential for trade to suddenly get locked up as a result of social distancing measures, government lockdowns, etc. And the key weakness as we saw it and still see it is trade's reliance on paper documentation. So the millions, if not billions, of pieces of paper that go around the world with every single merchandise shipment. What's quite remarkable, and I don't certainly mean to sound pessimistic, is despite the rapid digitalization we've seen in many areas of the economy, so I think last year, for instance, there was a 40% increase in e-commerce in the US. If you look in the trade space or the trade process space, there was very little progress made. So 0.01% of bills of lading were digitized last year, no change from 2019. So essentially the trading system in terms of its reliance on paper seems absolutely immune to the effects of the pandemic. We think there is one pivotal move that governments can make, and it is just a start, but one pivotal move governments can make to accelerate the pace of digitalization, which is adoption of modern laws and harmonized laws to give full legal effect to electronic trade documentation, particularly negotiable bills, things like bills of lading. There is a model law that has existed, created by the UN, or UNCITRAL, its Commission on International Trade Law, called MLETR, the Model Law on Electronic Transferable Records, which we think is absolutely fit for purpose. The sad thing is only 2 governments to date have enacted it. And the sad reality is, for instance, if you're in the UK and you want to go fully digital, your lawyers will inevitably tell you that if you need to claim title to some goods, if you don't have a paper-based copy of the bill of lading, or if you don't have the original, you're unlikely to be able to enforce that in a court of law, which we think ultimately pushes everything back into the physical space. And often we see people operating on digital platforms and running paper-based processes in parallel. So the headline message that we sent to governments around the world has been to adopt MLETR, or to adopt legislation compliant with UNCITRAL's MLETR. The good news is we're seeing some progress. So more and more governments seem to be looking at ratifying legislation. And just a few weeks ago, as a result of a tremendous advocacy campaign run through our national committee network, the G7, or specifically the G7 digital ministers, committed to enact MLETR by the end of next year. So we think that's a huge opportunity to really provide that foundational legal base to make trade truly digital.
Wow, I mean, certainly I've been hearing that for my entire career. I guess it's nothing like a crisis, Andrew, to accelerate things, to take advantage of a good crisis, as they say, right? Let's move over to Rob from IBM. COVID is now viewed as having really accelerated the pace of digital transformation, as I was just referring, across all facets of industry. So how are you seeing the impact in supply chains, and what do leaders of companies need to be thinking about in this regard?
Thanks, John. And I would amplify what Andrew was just sharing, right? That certainly supply chain has been, as a kind of discipline, has been, I think, slow to adopt, right, digital technologies, right? And one of the things we're watching is there's been about $5 billion of venture investment that's gone into supply chain startups in the last couple of years. So we think there's this enormous sort of groundswell that's going to kind of be infused into the supply chain space. But if you ask me the kind of simple answer to what leaders should be focused on, and I say this as somebody who spent a lot of my career on factory floors and warehouses and loading docks, right? But the one thing I would tell leaders to be really focused on right now is cloud. And I'm not talking about cloud as an IT topic, like how do I modernize my supply chain applications, or how do I move workloads out of on-premise data centers, but really about encouraging supply chain leaders to think about cloud as a giant accelerant of business transformation. And kind of here's how that works, right? And it really starts with, and Ron was referencing some of this a couple minutes ago, but it starts with data, right? And one of the biggest challenges in operating a supply chain, right, that's connected kind of end to end with partners upstream, downstream throughout the ecosystem is the flow of data, which cloud is now something that allows to flow much more freely in a flexible, scalable, and lower cost way than we've ever been able to achieve, right, as a profession before. But what that really does is allow companies, right, or supply chain operators to connect their data, right, across many legacy systems or ERP instances with external data from the outside world, right? And once that platform exists, right, now there are tools, right, that allow our customers actually to visualize their supply chains end to end, what's happening in real time, right? Because we've taken the inaccuracies and latencies out of that data, right? And so I now get an end-to-end view in a way that I've never been able to see before. Now I have the data where I can start in building predictive analytics, things that actually allow us to look ahead, look around the corner, identify the problem shipments and orders, right, before it's actually visible to the customer. And do things like the predictive ETA that Ron was talking about, which you think is like, that seems like a really simple concept, but it's actually very challenging to kind of execute, right, from a data and analytics perspective. And then we go beyond, like we can actually use machine learning and now early stage AI to actually use that data to recommend the next best actions to human beings. So that changes the role of humans from being people who kind of manage or enter transactions to people who deal with exceptions, right? And that's kind of, it's much more empowering for people, much more interesting work, right? So all of that kind of rolled together is something that IBM, what we're calling intelligent workflows, right? Big focus for us. And I know a lot of this sounds very futuristic, but frankly, the companies that we're talking about that really distinguished themselves through the pandemic, right, in terms of how they operated, their ability to react and flex and be agile, right, like this is how they run their businesses.
Well, yeah, I mean, I certainly the trends in this respect have accelerated more so in the past year than I've ever seen in my career. Ron, I'd like to ask you, I mean, we talked about digitization, but I'd like to couple that with ESG. So, when it comes to supply chain decarbonization, what role do you see technology playing in delivering on the promise of the net zero future that we all talk about?
Sure. So I think the ask is quite complex in a sense. I mean, if you look at maritime, so if I look at my industry over the last few years, certainly the ocean element of decarbonisation, we've looked at things like the NOx and SOx emissions, nitrous oxide, sulfur dioxide, and largely dealt with that as a critical component of ESG. And then last year we also changed, as an industry, I'm speaking on behalf of the industry here, changed to low sulfur marine fuel. So I think, in essence, we're moving in the right direction. But when it comes to decarbonisation, the key issue that I'm hearing from potential customers and existing customers is a lack of clear global standards. What do they have to work to? There's at least 10 that we're looking at the moment. So that's quite a challenge. I mean, there've been some pretty impressive goals that have been set by companies like Shell and BP to hit net zero by 2050. I was watching a webcast on Tuesday this week by Bernard Looney, the CEO of BP, and he was describing greening companies. So companies who are moving in the right direction, but they're not there yet, but at least they're going in that direction. And his take was that the world can't transition fast enough without global energy companies to make it happen. We still need energy, whatever we do. So I see the role of companies across our industry, not just maritime, but broadly into supply chain, shippers, freight forwarders, the whole ecosystem, increasingly taking a role in a circular economy. And I think there's some brilliant work that's been done on this by the Ellen MacArthur Foundation. I don't know if you've come across it, but I love the concept of cradle to cradle instead of the kind of more wasteful cradle to grave that the world is currently geared towards. If anybody hasn't come across it, the idea is there's three principles. It's designing out waste and pollution in the first place, keeping products and materials in use, and regenerating natural systems. So to your question, John, about ESG, I think actually where we go from here is moving from a GRC, governance, risk and compliance type model, which is where we're emerging from, certainly in my company, to an ESG model, which is environmental, social governance type model, because I think investors want to see it, and I think it's the right thing to do.
Cradle to cradle. I'm going to reuse that expression, if you don't mind.
Excellent.
Great. So let's talk about some of the other risks and issues in the supply chain, in particular diversification of supply and sourcing, but other areas as well, and how companies should be managing these issues. So Andrew, from the ICC perspective, what are you hearing from your network about the corporate intentions to reshore operations, building on some of Rosemary's points earlier?
Bluntly put, none. So the watchword in terms of what we've been hearing is all around resilience, which clearly speaks to diversification of supply, access to real-time data, et cetera, et cetera. We haven't spoken to any major corporates, unless they're hiding information from us, who have said that they're looking to reshore or nearshore. And I think that perhaps speaks to the economic and ultimately the operational reality around the reshoring discussion. And I think it's important to emphasize that when we speak to chief supply chain officers, for instance, at multinational companies, cost is an issue, but the issue of labor cost isn't the determinant factor in terms of where companies source. I think a really good example is the global vaccine supply chain. So it's tremendous that the US has such remarkable vaccine manufacturing capacity. It's great what Operation Warp Speed has done in terms of raising that capacity in record speed. But ultimately, the final manufacturing of vaccines relies on a highly diverse group of supplier countries. There are products in the Pfizer vaccine that can only be sourced from Chile because that's where they grow. So diversity, reshoring and building domestic manufacturing capacity is one thing, but the reliance on global supply chains, particularly for raw materials, but not limited to raw materials, will always remain. Second thing I would say is I think people often underestimate the degree to which research and development and knowledge and skills and technology are now devolved through global supply chains. And I know firsthand from the sportswear and fashion industry, the degree to which design, product innovation are actually devolved down in many countries in Southeast Asia, for instance. It's not happening in Nike in Portland, Oregon. So I think there is an almost essential nature of global supply chains as they exist today that will not wither. Clearly, governments will want to look at domestic manufacturing in essential areas, be it microchips, vaccines, medical goods, whatever else. But I think more broadly, it's difficult to see supply chains withering. And I think reports of the death of globalization have been grossly overstated. And I think it's instructive that McKinsey, who I think called global value chains dead at the start of the pandemic, if you look on their website, you now can no longer find that report. And I think that tells you a pretty clear story.
Well, Andrew, as a trade finance banker, I'm hoping that you're right. But I'm going to move to Rosemary to see if she has a different view on that. But more specifically, Rosemary, I'm going to ask you, if you do still believe in the reshoring philosophy, I mean, I know it is common knowledge that there's lower cost production environments than we have in, say, the U.S. You know, how can a company make the business case for manufacturing in the U.S. if it's so much more expensive than other areas?
Yeah, first of all, I think it's a misnomer to say, you know, we shipped everything offshore to China and now we're going to bring everything back. I mean, that's a oversimplification. It doesn't really work that way. What I see is an evolution in thinking by executives in the C-suite who are now evaluating their overall global strategy. And that's different than just saying we're going to reshore, we're going to bring everything back. I mean, I don't think that's reality. And let me start with a story, though, because the topic of digitization is very important in making a determination on where you're going to manufacture. So a few years ago, I was in China working with the client, and they wanted to go see a machine shop where they were buying products from this machine shop. So I tagged along that day. We were in Beijing out on the Fifth Ring Road. If you've been in Beijing, so that's pretty far out, about an hour and a half from central Beijing. And so we got to the factory, and the manager met us at the door, and he said he had to go take a conference call and just go ahead and walk through the factory. That was fine, unaccompanied. With no eye protection, no toe protection, no gloves, nothing. So we're in this machine tool factory where they were cutting steel, and I mean, it was loud and it smelled bad, and there were people running machines that didn't have any gloves or no lead apron or nothing. I mean, it was astonishing. And this was in one of it's a partially state-owned factory, and this is one of their star performing factories. And so as I'm walking down the middle of the section of the machine shop with some of my colleagues from my client, I started to feel very uncomfortable. There just were, there was no protection, no OSHA standards like we would expect in the Western world, no yellow lines on the floor. We were just walking in and out of the machines. And so, I began to feel it was dangerous. And so I backed up and then started taking pictures. And, I asked if I could take pictures, and they're like, sure, go ahead. So all these things are highly unusual in most factories. And the reason why I tell this story is because it was very clear to me at that point that the low cost is not only related, the low cost of overseas production is not only related to lower cost labor, which is certainly a big factor, but also the overall operations are lower cost because they don't have to achieve the standards that we would see in the Western world. So fast forward to the Reshoring Institute, and one of the first things we did was compare labor rates around the world. And we looked at a machine tool operator in China, and that guy was making $4.63 an hour. The same job description running a machine tool in the US was $26.10 an hour, fully burdened. And in Europe, it was even higher, about $32 and change for the same job. So you can see that even if wage rates quadrupled in China, it still wouldn't match the cost that it is in the US. So, this is a very important idea and concept, because unless we can extract labor out of a production environment, there's no way we can compete in Europe or in the US. And so digitization and the use of robotics, the use of artificial intelligence, the use of IoT, all these things must be introduced into a production environment in order to make it cost competitive and extract labor at the same time increasing productivity. So, it's an evolution, but as I mentioned before, in my experience dealing with about 80 clients worldwide, big and medium sized, and, all different varieties and different industries, almost 100% of them are going to make a decision based on economics. So, the place to start is to try to find a factory, or to establish or design a factory that is going to be modern, that uses all the technology possible, that is reliant on data collection and data management in order to gain the most productivity out of that production environment. That's the only way that the Western world can establish a somewhat competitive pricing. Now, we also know that when we do cost comparisons and TCOs, we know that the production in the Western world is about 15 to 20% more expensive when we extract that labor and improve productivity. But we also know that in America, anyway, Americans are willing to pay more for products that are made here, for no good reason. We did a survey and asked Americans if they preferred to buy products made in the USA, and the answer was yes, about 80% of the time, and they were willing to pay up to 20% more for those products, not because they were different or better or anything else. It's strictly a perception. We posted the results of that survey there. You can click through it on the landing page on the reshoringinstitute.org. And it was really fascinating. So, if you use that number, 15 to 20%, and you can design your operations in any country around the world to be relatively competitive, or within that 15% margin more cost, then you can make a case for locating factories there. So, it's more complicated than the simple, let's move to China and let's move back. That isn't going to cut it. You have to understand the total cost environment, as well as what's available from federal funding, as we talked about before, as well as the environment may be appropriate for manufacturing in those locations. And the last thing I will say is that we work with a lot of universities right now, about 15 in the US, but we also worked with a group of universities across Europe and found the same thing happening across Europe. So if you can make the case for bringing manufacturing back based on economics, move towards a more technical and wired environment, per se, then you have a winning formula.
Thanks, Rosemary. We have a ton of questions, so I'll do a quick lightning round for our last few minutes so quick answers to some of these great questions that have come in from our audience. So we'll start with Rob. As a question for you. If digitization is the answer to trade disruption, are corporates and banks ready for the growing problem of cybercrime? What should they be doing about it?
Yeah, well, I think a quick answer is no, right? And we've, just a couple examples in the last, 30 days, right? Clearly, this is this whole kind of security and risk management is a huge issue. I think it's broader than cyber, or at least that's the way we're thinking about it. But this is actually another good digitization use case, right? Because the ability to detect and respond is all around kind of using data, right? Kind of from outside the four walls of the enterprise, connecting that right with our internal operational data, right? To basically detect things right in real time and respond, right? And our approach is sort of like knowledge plus time creates options, and that we do that in our own business today, right? To protect against those kinds of risks. So this is going to be a huge next frontier for supply chain for sure.
For sure. Andrew, question for you. Similar to WHO coordinating vaccines for poorer countries, should the ICC coordinate funding for SME suppliers strapped for cash?
So we are looking, there are limits to what we can do as a non-profit institution in this space, but we have been looking at a number of partnerships under a new platform that we call ICC Trade Now to look at how we can potentially scale innovative trade finance offerings from fintechs, hedge funds, etc. But obviously there are limits, as I mentioned, to what we can do as ICC. And I think that the critical thing is to make sure, in terms of maintaining liquidity in the trade finance market, that governments keep their eye on the ball. They look carefully at credit conditions. They heed the lessons from the Asian financial crisis and the global financial crisis. The trade finance market can seize up very, very rapidly and before other asset classes quite often. And I think we need to see early interventions to make sure that there are credit guarantees to make sure companies can get cost-effective trade credit if, as we fear, credit conditions tighten either later this year or into 2022.
Thanks. And one last question, if we can sneak it in real quick, for a question for Ron. Home Depot recently contracted its own container ship to better control ocean freight logistics. Is this likely to become more common?
Yes, I think so. If you wanted a really quick answer, I think so. Yeah, there's a global shortage of vessels, so it's increasingly apparent that that's going to be the case. I've seen it with a bunch of different companies in in Denmark particularly. It's happening a lot in places you wouldn't expect it to happen, to shore up the demand.
Great. Okay. I mean, I think we finished right on time. It's been a great session. We could go on, I think, for a lot longer, and I'd like to, and we certainly have enough questions to do it. So maybe the next GTR session we'll pick up where we left off. Thank you very much, everybody.